And the reason the price is down right now is actually the reason why it's going to be up so much in the future. And that is Bitcoin's the best functioning fire alarm for liquidity. It's driven by liquidity in the financial system. And it's driven by, aggressive liquidity, risk-taking liquidity. People who want to take risk, want to speculate, would look at something new, a new technology like an NVIDIA, and they would speculate in it. And Bitcoin represents that. And so, my view is that what Bitcoin's price being down right now tells you is that liquidity is getting tight. And I've seen a lot of charts that suggest that. And in fact, we've also seen the Federal Reserve, reverse their policy and start printing money again. So that suggests that. Even, in a tight liquidity environment, gold could do well, primarily because what happens is people are looking for a safe haven. And so gold becomes like a bond. And so, that's really what's happened. We've had a liquidity squeeze. And so Bitcoin has contracted down to the lower end of its range. But I think what that's going to lead to is a situation where the government literally has to print money, a big print, as I would say, again, and that when that occurs, Bitcoin's going to rocket to the high end of the range, and the high end of the range is going to be 250 to 300.
That man has been invested in Bitcoin since 2013. He watched it go from $17 to $3 and doubled down. He watched it go from $65,000 to $15,000 and held. He runs a professional investment fund. He has real money on the line. And he just told you, completely calm, zero emotion, that the math says they have to print. And when they print, Bitcoin wakes up. Here's the full argument. Because if you hold any Bitcoin or crypto right now, you need to understand exactly what he's saying before the next move happens.
Although, gold and silver worked really well last year, Bitcoin hasn't been working so much recently. And we can talk about that. And I talk about why. I'm quite confident it is going to work. It's the right place to be. But it's gone through one of its, as it does, it's gone through one of its significant drawdowns, and it's testing the faithful.
Yeah.
So we can talk about that.
Well, what exactly does the book mean by the big print? Not just that the government has a tendency to do this, but what is the big print?
Yeah, let's talk about that. Well, so, since we entered this modern monetary era post-1971, where Nixon took us off the gold standard, the government has always been, running, not always, but generally speaking, been running deficits, and they print money to cover those deficits. But it really got more severe. And I say the book is entitled The Big Print. It'll actually be the third one. And the first one was the great financial crisis, when Ben Bernanke took the Fed balance sheet from 800 billion to 3+ trillion in the space of 2 or 3 years. The second one was COVID, where they went from 3+ trillion to 9 trillion. Of course, it's come back in a little bit since then. But and what I would suggest, and the book talks about, is the fact that the way things are structured with using debt to grow, debt is the engine for growth. And the problem with using debt as your engine for growth is that when you get in debt, you need to pay interest on it, and you need to repay the debt at some point in time. And if the amount of money in circulation is not expanding, the debt's going to go bad. And so the more we take on debt, the more we deficit spend, the more it puts us into really almost just, this isn't a matter of an opinion, Tom, it's more mathematical fact that they have to print money or else the whole thing collapses. And so the book takes you through kind of a very structured argument of how and why it happened twice before, once with the housing crisis, next time with COVID. And my thesis and my belief is that mathematically, there's going to be another one coming. And it's actually, there's some signs that it's starting. I mean, we can look at the Japanese bond market, or you can look at the fact that in the last part of 2025, the Fed created a new program called reserve management, which interestingly, they say it's not QE, but it really is the same thing as QE. And that, what is that? What does that mean? It means they stopped shrinking their balance sheet, started growing their balance sheet, injecting newly printed reserves. They literally just hit a mouse key, and the reserves in the system go up by $40 billion a month. And so, others have called it a gradual print, and that's true. I mean, 40 billion a month is 480 a year. That's not the same as, GFC or COVID, where they printed literally trillions in very short periods of time. But the point is, the tide is shifting. We were tightening, trying to get things under control because of all the inflation that the COVID print caused. And what they've now come to the conclusion is, we can't do that. And the reason we can't do that is they know that if things get too tight, they'll have a deflationary collapse on their hands. And so, the system we've got is just it's an out of control system where we're either looking at severe inflation or severe deflation. And they're trying to steer it down the middle, and that's what I would do too. But they're not doing a particularly good job of it because they keep hitting the guardrails. And I think they're going to hit another guardrail. My estimate is sometime in the next year and a half, and when they do, they'll print more, and then we'll have another round of inflation. So that's kind of the big picture view, right?
Do you have an opinion on Kevin Warsh, the Fed nominee from Trump?
It's a great question. He's a little bit of an enigma.
Yeah.
Some people say he's a hawk. He said some hawkish things. He said some dovish things.
But if he were a hawk, why would Trump want to nominate him? His whole argument, is that Jerome Powell isn't soft enough.
That's a great question, Tom. And I've said this to a few other of my friends. I kind of think if you really need to have a dovish policy, and they kind of do because of what I've described mathematically, wouldn't you want to put a hawk in there to do it?
Yeah, sure.
It's kind of like, we were trying to do an entente with China. Well, you couldn't send, a real softy over to China. You had to send a hard ass like Nixon,
right.
So there's an argument that I think what happened here is I think the fix is in, and they went to Kevin and said, look, do you want to be Fed chair? Yes. Okay. You've got a good reputation. You'll get approved. Jamie Dimon likes you, etc. So, but you do understand that what we have to do is we've got to, change the direction here. And, two things have happened since he got in there that I think are meaningful. One, he's made some statements about, he thinks that AI is increasing productivity rapidly enough that monetary policy can be looser. I thought that was pretty interesting. That's kind of what Greenspan said in 95 and 96. He said technology was changing things and it justified loosening. So I think there's a good chance he's actually going to cut interest rates. He's going to succeed at that. I don't think Trump would have picked him if he thought he wasn't going to cut interest rates. He's talked in the past about reducing the size of the balance sheet, and I don't think there's any doubt that he would like to, but mathematically he can't. But I think what's going to happen here, if you read the tea leaves, is Scott Bessent, the Treasury Secretary, has talked about a program whereby whereby the Treasury and the Fed will kind of work in concert to keep everything, going and going forward. And of course, the big challenge they face is they'd have to roll over $9 to $10 trillion worth of short-term bills this year. And so here's my guesstimate as to what's going to happen, and it's literally just a guess. I think, Powell will leave in May, Warsh will come in, and there will be some kind of an announcement that the Treasury and the Fed have entered into some sort of agreement, and and what they will do is they'll create a new program, there'll be some new name to it. It'll sound benign, but the net effect of it will be they'll figure out a way to get money to the banks so that the banks can then buy the bonds and at a small spread, and the banks will make a profit on doing that. And that's kind of what they did in World War I too. They issued Liberty bonds, and then they gave the banks a chance to buy, to get new money from the Fed at a lower rate, and the banks made money. So maybe the Fed balance sheet doesn't grow, but the bank balance sheets will grow massively in order to support that debt level. Because one thing we do know, and this goes back to the math, they cannot have interest expense continue to go up. They've got to get it down. It's over $1 trillion run rate today. It's a huge piece of the budget. It's, if the deficit's 1.8 to 2, half the deficit's interest rate. So if they could cut interest rates a lot, particularly the short-term bill rate, that would help them with their deficit problem. So my sense is it's going to be kind of a mixed bag of policies that keep kicking the can down the road. But one thing is for sure, those of us who know how it all works will identify it, and it will be printing money, and M2 will grow, and that will be inflationary. And that's all that really matters. If M2 grows, that's the definition of inflation: more money, same amount of goods. And so, we'll be back where we were before. And in my opinion, those assets I mentioned earlier, gold, silver, Bitcoin, will plow onto new highs as that kind of unfolds.
3 things. Quick. 1, the math isn't an opinion. Larry isn't saying the government will print because they want to. He's saying they mathematically have no choice. Interest on the debt is over $1 trillion a year. Half the deficit is just interest payments. If they don't cut rates and get new money into the system, the debt goes bad and the whole thing collapses. That's not politics. That's arithmetic. And the people running the Treasury know it, too. The new name won't matter. When the next program comes, And Larry thinks it's coming in the next year to 18 months. It won't be called QE. It'll have some new name. It'll sound technical and boring and responsible. But the net effect will be the same thing that happened in 2008 and in COVID. More money in the system. And every single time that has happened, gold, silver, and Bitcoin have gone up. Those are the only 3 assets the government structurally cannot print. 3. If you miss the 20 best days, you made nothing. That stat should terrify every person who thinks they'll time this. Over 7 years, Bitcoin went up 600%. Missed the best 20 days. You made 0. When Bitcoin moves, it doesn't go from 60 to 90. It goes from 60 to 250 in a short window. And nobody rings a bell before that happens. Larry's been in this since 2013. He survived every crash. He bought more at every low. And right now he is selling gold and silver profits and putting them into Bitcoin. That's the warning. Not panic, not fear. A very calm, very specific, very data-driven warning from someone who has been right about this longer than most people have even known Bitcoin existed. Subscribe. Every week we break down exactly this kind of conversation. See you in the next one.